I wanted to do this video on how to price risk if you are a property investor. Now, most amateur property investors, when they look at property deals, if there's a few things about the deal that isn't normal, that doesn't make it a perfect deal, they usually just put it in the too hard bucket and walk away. Now, just because there's a few things wrong with the deal, if you're a savvy investor, there's no reason why you can't proceed. My name's Thomas O'Regan. Over the last 4 years, me and my wife have 20x our equity position in a property portfolio. And today I wanted to tell you guys a critical thing in how to proceed profitably with deals that are a bit hairy. Now, I'm going to use the example, I like buying strata buildings. Some people might not, but that's okay. You can still listen to the end of this video because it doesn't matter what the issues are. It could be like a major repair required on the property or a high strata build. Doesn't really matter. You price risk the same, or you price risk with the same formula. Now, again, for this example, I'm going to look at a property, or I'm going to use the numbers on a property that I am currently looking at. Now, for me, for my appetite in what I'm looking for to purchase a property currently is I'm looking to purchase a property currently that is worth up to 330K, and I'm comfortable to purchase that property if the rental income is $550 per week and the total outgoing expenses are about $8,000. Sorry, $8,000 per year. So basically, when I purchase properties like this at the current interest rate, in the current interest rate environment, which is about 6.5% interest only, if I'm to put down a 10% or sometimes even a 20% deposit, usually these properties with a $550 rental income per week are producing enough income to support themselves in terms of paying all the outgoing holding costs and paying the mortgage. Now, that is key. It's not relevant to the point of this video, but I just want to make a side note. Buying properties at, that are generating enough income to support themselves and some is key to growing a large property portfolio. I'm not going to get into that anymore, but let's get into the numbers of this deal. So basically, my appetite, as I said, for properties is I can pay up to $330,000 and I would be looking at about $8,000 of outgoings per year. Now that usually, if you break the numbers down within the outgoings, usually I'm going to max out with strata, the annual strata fees or OC. OC fees of the property per year are about $4,000 of that total $8,000 outcome. Now let's just focus on the $4,000, okay? So $4,000 is the higher end of the strata bills that I want to be paying per year for any given property at a $330,000 price point. But what happens if I find a deal that does have potential, like it's a good property with good upside for capital growth and the cash flow is still quite good, and it's below replacement cost? What happens if for some reason the strata bill on this property is $8,000 per year? So it's effectively double over what the maximum I am willing to pay is. Well, it doesn't mean I just throw that deal in the bin and say that's too hard, because that's what an amateur would do, and you don't need to find a perfect deal. What you can do is you can actually negotiate that deal to make the numbers work for you, because most people will just simply throw that property in the too hard basket and won't go for it. But you as a savvy investor can take advantage of that opportunity and negotiate a really good deal. What do I mean? Okay, so basically we've identified that for this property, it's going to cost us, because the strata bill, our maximum allowable cost on strata is normally $4,000 per year, but this one's $8,000. That means this property, to hold it, is going to cost us an extra $4,000 per year. So how do we price the risk, right? So basically, if I was to buy the property for $330,000, maybe I'd put around a 10% deposit down. The total loan on the property would be around 300K, and I'd be paying 6.5% interest only on that 3.5K. Now, I want to pull that to price the risk. I want to effectively reduce my mortgage repayments to the point where I'm paying $4,000 less in my mortgage to offset the fact that the strata bill's higher. So how do I do that? So instead of this property paying $330, which is my max limit on a property that has $4,000 of strata cost per year, I can pay a maximum of $280,000 on this property. Okay? Now, how does that work? So basically, I would ask for a $50,000 discount on this property and 6.5% interest only of $50,000 is around about $4,000. So this property in the mortgage repayments, I'm going to be paying $4,000 less per year. Therefore, it's the same as me paying $4,000 in strata bill, except I'm not. I'm paying $8,000 in strata bill. The mortgage repayments will just be lower, so it will offset the total cost of holding the property. Everything else is the same, okay? All the other outgoing costs are the same, except the strata, and the mortgage is $4,000 less than it would otherwise be. Now, here's the thing you've got to understand. Maybe the vendor or the sales agent doesn't want to give you a $50,000 discount. Well, obviously, that would not be a good deal then. So you've got to understand that. But what you've got to understand is don't just simply put it in a too hard basket, because there can be a deal done here. You just need to, as I said, price the risk, okay? So if you're looking at a property as an investment, you should have criteria. You should have targets of how much cash flow you need the property to get. You should have targets of how much maximum outgoings you want this property to be, and you should have targets of what is the maximum amount of loan you can pay on this property. And you can play around with all these numbers to get a good deal done, but don't be super fixed on your numbers, you know what I mean? Like, don't be fixated on, I can spend no more than $17,000, for example, per year on my mortgage, and I can spend no more than $8,000 on my outgoings per year. The reality is you can play around with these two numbers and have them equal the same amount at the end of the day, but each one is different from the other deal. So what I really like about doing these a little bit more creative deals that most people put in the too hard basket is, for like the strata costs on this property are $8,000, right? Which is $4,000 more than we would be comfortable paying. And as I said, most people are just going to not go for the deal because the strata bills are too high. But what if the reason the strata bill was so high was because in the building they were doing some sort of roof repair, right? So if they're spending extra money to do a roof repair, that's something that's not going to be there. That high strata bill is something that is not going to be there forever. So the strata bill will effectively, in a short period of time, normalize. And this is the benefit of negotiating deals that have issues, right? Once the strata bill normalizes, this deal will go from an average deal or a deal that you were happy with to a very good deal, because the strata bill will go from $8,000 a year back down to normal $4,000 a year, and then it will be throwing off excessive cash flow in a short period of time, more than the deals you would have otherwise done that were normal. Okay, so I hope this video has helped, and if you have any questions on how to price other risks like renovations, other things like that, please reach out, because you can literally, as an investor, you can price any risk and any deal can be done. It's just a matter of paying the right amount of money for the risk you are going to take on to get a good deal done. But the best thing about pricing risk is what you want to do is you want to put margin in the deal. You want to overprice the risk. So when the rubber hits the road and the risk either needs to start costing you money, the risk is costing you less than you have predicted. And another good thing about pricing risk is you can identify the risk and you can price the risk and you can get a deal accepted without actually having the risk occur. Like, for example, a property that may need a bathroom renovation, when you at a glance, it may need a bathroom renovation. So you price the risk as if it needs a bathroom renovation, and you get that price reduction accepted. But then after further investigation, you find out that it really didn't need a major bathroom renovation. It just needed a minor cosmetic bathroom renovation or something like that. I've had many situations where I've priced the risk into the deal and it's turned out that the risk cost less, or it didn't cost anything at all when it came time when I owned the property. So hopefully this helps, and good luck investing. See you guys. Bye.